Everyone thinks that having a high cap rate means high cash flow, but that's completely wrong and can cost you millions of dollars or make you invest in the wrong assets that really take up all your time and all your focus and all your money. It's so crucial to understand that cap rate does not equal cash flow. Good rule of thumb, but bad way to live on. I've seen so many transactions for $1.6 billion in deals with my team over the past few years not have great cash flow and or was way more work than people thought it would be to stabilize the property and make great cash flow. I'm going to break down for you today this one quick video. What cap rate truly is, how to find cash flow, and how to understand what makes a good investment moving forward. Now, when looking at cap rate just tells us what is the property worth. That's all it really says. Is it at a good price or not? Now, if it is a high cap rate, that means problems. More often than not, high cap rate means problems. Low cap rate means no problems or little problems, because real estate, there will always be some kind of issue going on in the real estate scenarios. So I'm looking at this cash flow, like my whole goal is to just have cash flow and do no work. One, that's either be an LP, limited partner, just an investor in properties, or I have to find low cap rates. Think 3 to 7%, maybe even 6%. 7 is kind of high. So like 3 to 6%. High cap rate, 7 plus. If I'm investing in a 7 or higher cap rate, that means there are problems. Either OpEx or CapEx. OpEx is going to be, operational. Maybe they have bad management. Maybe they're overpaying for management. Maybe they have bad expenses. They're not, utilizing the resources they have at hand to reduce their overhead. That's the burn rate. Then you have all CapEx. This is a big killer when it comes to your cash flow. If I buy a property and I know I can install new fence or new automations or add more employees, those are going to be my CapEx. Not the employee part, but like anything that's hard costs. New roof, new foundation, new fences are all CapEx. Employees is OpEx. Those two things can determine a lot on what the cash flow is for you in cash flow. Now, for the no problems, think triple net, think Starbucks, think Dollar General, think coffee shops even. Those places normally have low cap rate, a safe investment just for cash flow. Now I'm looking at this scenario here. What we really gotta understand is that if I'm investing in a property, let's say it costs us $1 million is the purchase price, and my NOI is $100,000. This means that I'm dividing this number to get 10% cap rate. Now, in theory, it is a higher cash flow opportunity because I have more net operating income. My NOI is 100K. If it's 200K, it's 20%, meaning it's either a massively huge discount for the property, or there are tons of problems right now going on that you need to fix that makes it harder. Once you stabilize it, I'm going to have new numbers here. If I'm investing for a 10 cap, the goal is probably to make it a 7 to 8 cap once I'm done and stabilize the property. Not to go up higher. I'm going to fix the property and have better returns for yourself and increase my equity and my net worth by doing so, plus my cash flow on the backside. So crucial. What really determines your cash flow are these couple of things. So cash flow is from the followers. One, your DSCR, your debt service coverage ratio. This tells me if I'm cash flowing or not. If it is a 1, it is break even. If it's a 0.75, I'm losing money. If it's 1.25, I'm making 25 cents per dollar, and then banks will be happy to give you money for this deal. It qualifies the loans. Now, I made a whole video up above that breaks down how to understand loans and down payments and so forth. But a quick story for you. I've seen so many transactions that look amazing on paper. And then the investor like, hey, I want to buy this property. It looks amazing. Let's do a pre-approval after we go LOI, send out there and do a PSA, which in theory makes sense. You know, deals move fast sometimes, and you don't want to lose it. But the problem is when you do this, when you don't know all loan servicing, you don't know all down payment requirement, or interest rates, or terms, this can make a property that has a 10 cap even, or even 20 cap, make us no money and break our cash flow. Because if I'm investing on a property and my debt to income ratio is 120K for some crazy reason, let's say it's like 15 years at a 9% interest rate, that means that I'm losing $20,000 on this property every single year. You don't want to do that. However, if you get pre-approved first, before you do all this, and I know that my debt to income ratio is 75K, because 30 years, 25 years, 7%, amazing. That means that I'm making $25,000 in my cash flow every single year by doing so. So that really makes you understand on your cash flow. So this is one part of cash flow, your DSCR. Next part of cash flow is going to be our CapEx. CapEx again is going to be anything that's structural. Me fixing roofs, fixing toilets, fixing properties, upgrading units, making them make-readies. It could be OpEx. If I buy a property and I know after I take over control that right now the cap rate's so high because there's no management in place, and I add a manager for $30K a year, that means that my NOI went from a 100K to a 70K, now I have a 7 cap. And if my loan costs me 70K to operate the property, I'm losing money or I'm breaking even. So to really understand how important it is to know that cap rate just tells you what is the price of the property in terms of like value. Another thing that affects cap rates is demand. If I'm in a secondary or tertiary markets, my demand will be much lower. So my cap rate is higher to make up that difference. Like I'm in Austin, Texas, and if my clients are investing in Austin, we're probably going to be buying 5, 6, 7% cap rates for multifamily or for other units and other kind of strategies because the demand is so high. But if I'm investing in like Wimberley or San Marcos, it's kind of outside of Austin, then I might get a 8, 9, 10% cap rate because of that reason too. So again, cap rate does not always mean the problem is the property itself. It could be the location. It could be how much traffic do we get by drive-by and free advertising. All these things make up our whole strategy when it comes to this. And these are our biggest ones. Now obviously with DSCR, I will even add is terms. It's terms, it's down payment, it's concessions. All these things, it's rates, make up the biggest part of a deal. Now obviously as well, it's at the purchase price too. Just because they want $1 million for it doesn't mean I'm buying it for $1 million. Like I say to my clients a couple weeks ago, saved them $275,000 off the ask price. Right now I'm in negotiations. If that one pulls through, we'll save one client like $600,000 on one single deal. And we'll bring it from a 5 cap to like a 9 cap for amazing returns, great property here in Austin, multifamily, strong asset. Only because though we understand negotiations, we understand DSCRs, we understand the terms and the market climate. It allows us to get better terms for our clients, i.e. you make more money with less stress. Now, if that sounds interesting to you, you want to have the best returns, save more money, down below, link in the description, how to call me directly. I can walk you through exactly our best strategies, how we can help you, how we can save you at least 5 to 6 figures on your next investment, make more cash flow, have a better investment, and have a better exit strategy as well moving forward. Now, again, no obligation, but you want that opportunity for yourself, totally for free, down below, call me directly. If I don't save you money, I work for free. And so far, all my clients have saved minimum 5+ figures by doing so. And now I'm going to break down for you this in real practice. I'm going to show you numbers to see exactly what it looks like in a real life scenario. Because obviously seeing all this stuff is great, but what does it actually mean when we look at the numbers together? So if I'm looking, let's say we go to our good old screen. Let's look at Crexy, for example. So here's a house right here, multifamily property. It is 20 units, pretty small, $1.4 million, 547 days on the market. Without doing a super deep underdive and underwriting process on this deal for saving you time, I'm just going to look at the NOI. So this NOI for this property here is a 9 cap at $97,000 a year. They want $1 million for it. So easy math for us to do here. Now for you, you want to understand underwriting at full level up above. A whole free video that breaks down underwriting from a true pro doing it. Again, my team's done $1.6 billion transactions over the past few years, so we kind of got it down to a science. But in this scenario, let's say that my NOI, I'm going to round up here, I'll make it super easy, is $100,000, and my PP purchase price is $8 million. Because I'm going to make up the difference. But hey, I want a 10 cap, give it to me for $1 million. That would make up the difference more or less, 60 kind of more on my strategy. So now I have a 10 cap. Make it really easy math. If I look at loan terms on this property, let's close out, go back over here. This can change greatly based on how we do things. So this is $1 million, and I do 30 years, which is probably won't happen for that kind of property. Definitely won't happen for that kind of property, but for easy math, we do 30 years at 7% and 20% down. If I do that, my P&I, because taxes on this stuff is already included in the overhead, is 63. So my debt service is 63. Let's say $64,000. Is my debt service. That means that my cash flow on this property now is $26K. Cash flow. So we make right now $26,000 cash flow before we assume anything. If I have to add in new management, have CapEx, this on paper, because that will change, but this looking at loan services, my cash flow is going to be $26,000. Now, again, this is 30 years, 7%, 20% down. If we change this though, it will change the whole entire math. So let's say for this property, my lender says, this is kind of risky. It's in a really bad market. It is RV parks. I'm not going to give you a 30-year loan. I'm going to give you a 20-year loan with 20% down and 7% loan. My math went from 63K to my new debt service being 75K. Oh, sorry, this is $34,000. So $36,000 sale cash flow down below. This gives us 25K. which is still good cash flow. You're looking at real estate, single family homes, you make about $100 per door per investment you have. So I have one property that costs us $500,000 or $1 million. I will make around $1,000 a year in net free cash flow. So I think commercial real estate is the best of the best for making great returns. So already I'm outdoing it by 25 times more on a pretty cheap property. But here's the thing. This is one setup. Now let's say we have the same lender. He said I can't do it for 20 years. I can do it for 15 years instead. And now we went from $86K. And now our new debt service is $87K. And now I'm only making $13K cash flow. You can see here how fast your cash flow can change just based on terms. And again, this is before we even add in OpEx or CapEx, stabilizing it, people breaking leases, doing evictions, the whole 9 yards. This is just off the debt by itself. And this is why cash flow alone is not enough to really show you, cap rate alone not enough to show you what your cash flow will be like. You gotta make sure you get your loan structured first. And then another thing, let's go even more extreme. Let's say your goal to get an SBA loan is to do 10% down. But 10% down at 15 years. Now, my math. If I did 10% down, so this is 30 years, 25 years, 20 years, and this one here is 15 years. Debt service is $96,000. My cash flow is $4K. This is why sometimes it's actually not always best to do the lowest you can for down payments if your goal is cash flow. Like your goal is to buy a property that's high cap rate, stabilize it, fix it, increase operations, increase CapEx, and then refinance in 2-3 years, then great. Having low down payments is actually fine because cash flow is not the name of the game for you. Your goal is equity and forced appreciation. And that way it does make sense. Again, this is why it's so crucial to understand why are you investing in real estate? Is it for cash flow or is it for equity plays? Equity plays, you can do less down because when you finance in 2-3 years and don't care as much about having a high cash flow, unless this is hold you over the water while you fix things. But for the most part, this is how you understand cash flow at a high level. It comes down to terms. Terms of everything. If it's all cash, if it's a high down payment, if it's low rates, high terms, big difference. If it's cap rates or OpEx or your CapEx, big difference. So down below, let me know. I'm super curious in the comment section. What do you invest for? Do you invest for high cap rates, for cash flow, quote unquote, or do you invest for low cap rate with true cash flow, or you want to have equity plays? Let me know down below, comment in the description. Let me see what you have down there. And of course, if you want more help and more support with me, actually walking through all this and more, from sourcing deals, underwriting deals, finding my lenders for you guys, and so much more, how to call me down below. If I don't save these 5 or 6 figures, we work for free. And so far, all our clients have saved a minimum of 5 figures. Honestly, on average, it's like $270K we save our clients. So that also by itself would change your NOI a lot. So this property is a contact sale. If this is a $1 million property and I got off $250 for you, we went from a 10 cap to like a 15 cap pretty quickly. So you can see how fast it is to increase your cap rates just by having different structures there. So you want help with that kind of strategies as well, down below, link in the description, have call with me, no obligation, but as always, thanks for watching. Make sure you like the button down below, subscribe, give us a share, and I'll see you at the top. Thanks for being here. Have the best day yet.